Welcome back to the Deep Dive. Today, we are heading straight to the southern tip of the African continent. We're talking South Africa.
Hmm.
And look, if you follow financial news, even, just casually, you probably have a very specific and likely conflicting image of this country in your head.
It's usually a complicated image, to be fair. It's rarely just one thing.
Exactly. You see headlines about stunning landscapes and resource wealth, and then the next day, it's all about blackouts and political noise.
Right. And that's what our sources for this deep dive are calling the South African paradox.
It's a perfect term for it. Think about it. On one side of the coin, you have the most sophisticated financial gateway to the entire continent.
Deep capital markets, world-class lawyers.
Stock exchanges that rival London or New York.
Hmm.
I mean, it's a first-world financial infrastructure.
And on the flip side...
The flip side is an economy that feels like it's constantly wrestling with itself. You've got volatility, major infrastructure challenges.
And those energy crisis headlines that just don't seem to go away. It's a real Jekyll and Hyde situation.
It is. And for a long time, the strategy for global investors was pretty simple, right? Just buy the index.
Buy the ETF, ride the wave, the beta strategy. Just get exposure.
But the main takeaway from the stack of reports and intelligence briefs we've analyzed for today is pretty blunt.
That era is over.
Completely over.
Yeah.
The idea of passive investment in South Africa. You can't just buy a broad emerging market ETF, sit back, and hope for the best anymore. That strategy is dead.
So if the spray and pray approach is dead, what replaces it?
That is our mission today. We are going to decode what our sources call the ecosystem of intelligence. You actually need to make money there.
It's about how smart money is moving towards a bespoke deal flow.
And why you need commercial spies, or let's call them intelligence firms. And we'll unpack a consumer base that is changing faster than any textbook can keep up with.
Yeah, we've got analysis on everything from venture builders to forensic investigators and some really deep behavioral data on what South Africans are actually buying.
And maybe more importantly, what they've stopped buying.
That's a big one.
Yeah.
This is all about moving from macro guessing to micro precision.
But before we get into the how, let's hit the why. Because despite all the doom and gloom, there's a number in this research that honestly, it just stopped me in my tracks.
The valuation gap, it's staggering. It's one of the most compelling data points in global finance right now.
It is. South African equities are trading at a massive discount. We're talking about a price to earnings, or PE multiple, of around 12.6x.
Which, just for context, is remarkably low.
Exactly. Compare that to developed markets, which are hovering around 16x, or even other emerging markets at 14.5x. South Africa is effectively on sale.
It's trading like a distressed asset, and that's the aha moment right there, isn't it?
It is.
It's what sophisticated investors call valuation arbitrage. You have these high-quality assets priced as if the local economy is going to stagnate forever.
The market is pricing in forever gloom.
Precisely. But here's the catch. Many of these companies aren't just reliant on the South African economy. They're positioned for regional growth across Africa, or they're global exporters.
So you're buying high-quality assets at a crisis discount.
That's the play.
Okay, so the price is right, but the environment is complex. And that leads us to our first big pillar, the architecture of intelligence. If you can't trust the broad market sentiment because it's too pessimistic, who do you trust?
This is where we see a fascinating shift. Investors are moving away from the big, generic global consultants.
So you're not just hiring a McKinsey or a Bain to tell you the strategy.
Not necessarily. If you're a serious investor entering this market now, you're hiring specialized local fixers.
Fixers makes it sound a bit illicit, like we're in a spy novel meeting someone in a parking garage.
I get that, yeah. But it's less spy novel and more commercial diplomacy. The reality is generic market data doesn't help you navigate the political complexity. You need people who understand the texture of the place.
Okay, so give me an example.
Let's look at a firm like Africa Practice. They don't just tell you the market size. They do what they call regulatory foresight.
Break that down for me. What does regulatory foresight look like in practice? Regulation usually feels like something that just happens to you.
Okay, take the Equiano subsea cable. This is a massive Google infrastructure project to bring high-speed internet to the region.
Right.
A standard consultant might look at the technical specs. Africa Practice went deeper. They calculated the wider economic impact to help unlock capital from development finance institutions, the DFIs.
So they weren't just checking if the cable works. They were proving the economic multipliers to the people writing the checks.
Exactly that. They could show that X amount of investment would yield Y amount of GDP growth. In a market like this, proving the developmental impact is often the key to unlocking funding from these huge global bodies.
That's the difference between a project dying on a spreadsheet and actually getting built.
Precisely.
And then staying in this intelligence lane, you have the darker side of things. Risk. Because let's be honest, risk is the first word that comes up in any committee meeting about South Africa.
It is. And usually people think of risk as just physical security. Is my factory safe?
Do we need more guards? Yeah.
But firms like Control Risks and SRM are showing that risk management is actually a strategic differentiator. SRM, for instance, focuses heavily on forensic diligence.
Forensic, like CSI for finance.
That is a great way to put it. We are talking asset tracing, deep cybersecurity audits, background checks that go back decades. You have to remember the context here.
Steinhoff.
The Steinhoff collapse is still fresh in everyone's memory. It was a massive retail conglomerate that basically imploded due to accounting fraud.
The Enron of South Africa.
It was a corporate governance disaster that wiped out billions. So what SRM provides is the verification layer. They make sure the company you're buying actually owns what they say they own.
No skeletons in the digital closet.
Exactly. In a market where governance can sometimes be opaque, that forensic stamp of approval is worth its weight in gold. It's insurance against catastrophe.
Okay, so you have your spies and your strategists. But here is the one that really surprised me in the research. The deal originators are the lawyers.
It's counterintuitive, isn't it?
Very. In the US or UK, lawyers usually come in at the end to do the paperwork. They're the know people.
Right. But in South Africa, the top-tier law firms are essentially intelligence hubs. They see the flows before anyone else does.
Okay, let's unpack that. The report highlights a firm, Bowman's.
Now, Bowman's is fascinating. They act as a Pan-African intelligence hub. Because they operate across the continent, they're tracking these cross-border flows in real time.
And what do they see?
The big trend they're flagging right now is South African champions, these big local companies aggressively acquiring assets in East and West Africa.
So if you want to know where South African capital is going next, you don't look at the stock market. You talk to Bowman's.
Precisely. They see the M&A activity before it ever hits the news. They know who's buying a bank in Kenya or a telco in Nigeria before the ink is even dry.
And then there's Weber Wenzel. The report pegs them as energy specialists, but not in the way I expected. They're not engineers.
No, but they're innovating on the finance structures. We all know the energy crisis, load shedding, the blackouts has been the biggest issue in the country for years.
Oh, we will definitely get to the energy opportunity later. It's massive.
Well, Weber Wenzel figured out the legal structures for crowdfunding and what's called embedded generation.
Okay.
Basically, they created the framework that allows small-scale renewable projects like solar on a shopping mall or a factory to get funded by private investors, completely outside of the slow government-run programs.
They built the legal rails for the private energy boom.
That's it. That is smart. Using the law to bypass the bottleneck, instead of waiting for the government to fix the grid, they wrote the contract that lets the private sector fix it themselves.
And lastly, on the law firms, South Africa.
South Africa is the conduit for Asian capital, and they're seeing a major shift. A decade ago, it was Chinese state money building big bridges and roads.
Government-to-government deals.
Right now, it's private sector money from Asia going into consumer goods and tech. If you want to understand the Asian pivot in Africa, ENS is the source.
So the lawyers are the new investment bankers. Okay, let's move to the money itself, finding the alpha, the returns that beat the market.
And the report argues that public auctions are just too expensive. If a company is for sale on the open market, you've already lost.
The market's too efficient. Everyone knows it's for sale. The price gets bid up.
Exactly. So smart money is moving to bespoke origination.
Which brings us to a firm called Ancol Capital. I love their model because it seems so unglamorous.
And that is exactly why it works. They don't sit back and wait for startups to pitch them. They manufacture deal flow.
And they aren't looking for the next shiny app.
No, they are looking at the mid-market real economy.
We're talking agri-processing, manufacturing, logistics, the stuff that actually makes the world go round.
Exactly. Boring, cash-generative businesses. Maybe it's a family-owned macadamia nut processing plant or a specialized logistics fleet. These companies are often too small for the global private equity giants, but too big for angel investors. They fall into a funding gap.
So Ancol finds them.
They find them, they clean up their operations, professionalize them, and then they package them for investors.
They're flipping factories, not houses.
In a way, yes. They're taking good businesses that are maybe badly run and turning them into great businesses.
And on the tech side of that, you have a different model, venture builders like the Delta.
Right, and this model addresses the huge risk problem that's just inherent in startups.
So how does a venture builder differ from just a normal venture capital fund?
A VC fund gives you money and, checks in once a quarter, maybe gives you some advice. The Delta changes the equation by providing shared resources.
Shared resources like?
Dev teams, strategy, legal, HR. A whole portfolio of startups shares these resources. So when you invest in a company coming out of the Delta, it is already pre-validated.
It's survived their internal boot camp.
Exactly. It de-risks the early stage significantly because you aren't just betting on 3 guys in a garage. You're betting on a machine that builds companies.
But we can't talk about South African tech without talking about the Apex predator.
Naspers Foundry.
They have a huge mandate, our $1.4 billion. That is serious capital in this market.
It is huge. And when Naspers Foundry invests, it acts as a seal of approval for an entire sector.
Give me an example.
Look at Sweep South, the home cleaning platform, or aerobotics in the agriculture space. Once Naspers got involved, the global guys started paying attention.
They are the signal in the noise.
That's it. If Naspers puts money in, everyone else just assumes the due diligence is solid.
Speaking of aerobotics, that falls into deep tech, hard science. The report mentions that South Africa is actually getting really good at this, specifically down in Stellenbosch.
Yeah, Launch Lab at Stellenbosch University. This is where you bridge the valley of death for these science-based startups.
The valley of death being that long period between having a scientific breakthrough and actually making any money from it.
That's the one. If you're building a food delivery app, you can launch in 6 months. If you're building biotech or climate tech, it might take 5 years of R&D before you sell a single thing.
And Launch Lab and funds like the University Technology Fund are designed to support that long gestation period.
Right. Holocene Ventures was mentioned there too, a climate tech fund. This is IP-heavy stuff. It takes longer to build, but the moat, the competitive advantage is massive.
Because it's based on hard science, not just marketing spend.
You can't just copy their code. You have to replicate their physics or their biology.
So we know how to find the companies. But for these companies to succeed, someone has to buy their products. And the South African consumer, well, they are changing drastically.
They really are. The sources refer to a concept from a group called Flux Trends. They call it the hermit consumer.
The hermit consumer. It sounds a bit sad, honestly, like everyone is hiding inside.
It's not necessarily sad. It's a rational reaction to the environment. It's the cocooning effect. People are retreating into their homes.
But that doesn't mean they aren't spending.
Not at all. They're spending money to make that home a fortress.
A fortress?
Think about it. High-speed fiber internet, backup power solutions to deal with the blackouts, premium streaming services, nice furniture. They're cutting back on going out to bars and restaurants.
And investing that money in the home hub. If you're selling home entertainment or home improvement, business is booming.
They are bringing the experience inside.
But it's not just about staying home. There's a harsh financial reality here, too. The report calls it pervasive pragmatism.
This is the brutal part of data. Trender shows a structural reset in spending. We are seeing a 47% reduction in spending on snacks and desserts.
47%.
Okay.
But the real kicker.
A 42% cut in alcohol consumption.
Wow. When you cut alcohol by over 40%, you know things are tight. That is usually the last thing to go.
Exactly. This isn't just a temporary dip. Consumers are structurally changing their shopping baskets. Brand loyalty is dead. Value is king.
If a cheaper brand does the job, they'll switch immediately. The premium tax that big brands use to charge is just disappearing.
It is, but, and here's where it gets really interesting. While the formal suburban consumer is cutting back, there's another economy that is absolutely booming.
The Kazi economy, the township economy.
Visible giant.
It really is invisible to many investors because they just never set foot there.
And that's the critical mistake. We have data from Kasi Insight, which tracks consumer confidence in the informal sector. And while the formal retail numbers look depressing, the township economy is dynamic.
What are they saying?
Massive volume, high adoption of mobile money, a vibrancy that the formal stats completely miss.
And yet most global investors ignore it because it doesn't show up on their standard GDP spreadsheets.
And if you're selling consumer goods in South Africa and you don't have a strategy for the township market, the spaza shops, the informal traders, you are missing half the market. It's that simple.
You can't win in South Africa by only selling to the suburbs.
You just can't.
The other trend mentioned is phygital, which sounds like a made-up marketing word, but bear with me.
It is a bit, but it's a useful one. It's the blend of physical and digital. The best example is Checkers 6060.
Right.
It's an app, but it relies on a massive physical network of stores to deliver groceries in 60 minutes. It feeds perfectly into that hermit consumer trend. I want my groceries, but I don't want to leave my house.
And re-commerce, the secondhand market.
Again, driven by that pragmatism we talked about, the circular economy, secondhand clothing, used electronics, is booming. It's expected to pass 100 billion rand in value.
And it's tech-enabled now. It's not just thrift stores.
No, it's online marketplaces like Yaga. People are monetizing their own closets.
Okay, so we have the consumer. Now let's talk emerging disruptors. We touched on energy earlier, but the report frames the crisis load shedding as perhaps the single biggest investment opportunity in the country.
It's the green transition by necessity. Because the state utility, Eskom, couldn't keep the lights on, the private sector effectively just took over.
So we're seeing this massive shift to decentralized, embedded generation.
Meaning solar panels on every roof.
And not just panels, it's the financing platforms, the installers, the battery storage systems. It's a whole new industry that didn't exist 10 years ago.
And now, thanks to those legal innovations we mentioned from Weber Wenzel, the capital can actually flow there. It's gone from a crisis to an asset class.
Then there's fintech. I feel like every analysis of Africa talks about fintech, but this report says we're moving beyond just payments.
We're moving to institutionalization. Look at Project Coca. This is led by the South African Reserve Bank.
Okay.
It's proof that the actual institutions are adopting blockchain. We aren't just talking about crypto speculation. We're talking about using distributed ledgers for interbank settlement.
The plumbing of the financial system is getting an upgrade.
Exactly. And then you have embedded finance.
So retailers offering insurance.
Telcos offering loans. The lines are blurring. If you have a customer base, you are now a bank. If you know your customers' buying habits, you can price risk better than a traditional bank can.
One more disruptor, logistics. Because if the hermit consumer is ordering everything online, someone has to deliver it.
Last mile logistics is critical, and it ties into cloud sovereignty. You have giants like Huawei Cloud and AWS expanding aggressively in South Africa.
You need that digital infrastructure, the rails, to run the whole thing.
You can't have one without the other. You can't have 60-minute delivery without a powerful cloud backend figuring out the optimal route.
Okay, so we have the opportunities. We have to deal with the red tape, the regulatory landscape. Seems like a mix of good news and bad news.
It is a double-edged sword. On one side, you have positive movements like the Startup Act, led by an organization called Simodisa.
What are they fighting for exactly?
They're pushing for tax incentives for angel investors and visa reforms to get talent into the country. If that passes, it could be a massive catalyst for the tech ecosystem.
Greases the wheels for everyone we just talked about.
Right. But then you have exchange controls. The nightmare of moving money out of the country.
It's complex.
It is. South Africa still restricts the flow of capital out. That's why you need those lawyers we talked about earlier. There are ways to structure things, specifically something called a loop structure.
Can you explain a loop structure
Simply?
Because it sounds a bit like tax avoidance.
It's not avoidance. It's structuring for global compliance. Think of it as a bridge. It allows a founder to move their intellectual property, their IP, to a jurisdiction like Delaware in the U.S.
To attract global VC money.
Exactly. But they can keep their operations, their staff, and their costs in South Africa.
So head in the U.S. for money, feet on the ground in South Africa for work.
That's it. It's a legal gymnastics routine, but it's essential if you want a global exit. Without it, global investors are often too scared of the exchange controls to invest.
They want the IP in a jurisdiction they understand.
Precisely.
So bringing this all together, we started with the paradox, a sophisticated gateway that is also a volatile emerging market.
And the synthesis here is that South Africa is a market for the informed active investor. You cannot be passive. You cannot rely on headlines.
You have to dig deeper.
You have to look at the real economy, manufacturing, agriculture, energy, not just the top 40 stocks on the JSE.
And you have to use the ecosystem.
Yes, exactly. Don't rely on a desk in London or New York to tell you what's happening. Use Ankle Capital for deals. Use Flux Trends to understand the consumer. Use Bowman's for the legal structure.
You have to leverage that local intelligence to bridge the gap between perceived risk and the real opportunity on the ground.
That's it. The opportunities are in the gaps. The gap between the state's failure in energy and the private sector's solution.
The gap between the formal retail stats and the booming township economy.
It really does seem like the formal data is only telling half the story.
And that leads to our final thought for you, the listener, to mull over. We talked about the Kasi economy, the township market, being invisible to many. If the formal data we all rely on misses that massive amount of activity in the informal sector, what other hidden champions are investors completely overlooking just because they are looking at the wrong spreadsheets?
That is the multi-billion rand question.
Thanks for diving in with us. We'll see you next time.